Hello there, Maverick Traders. This is Rob Reinhold. I'm joined by Mr. Darren Fisher, and I can't believe it, but this is the last trading room for the rest of 2022. Due to the holidays due to Christmas and New Year's falling on the weekend, this is the last one. We're not going to be holding them for the next 2 weeks due to the holidays. We're going to be wrapping up this year at the 1st of January with our year in review, and then this year's in the books. Darren, what did you think about this year quickly?
As long as you were on the short side for the most of the year, you had a really good year. We're going to go over this in the year in review, but we identified it early on that the trend was down, and as long as you're trading with that trend, you're probably sitting pretty good. I mean, you're not talking a whole lot at the cocktail parties this season, as everyone's bemoaning the fact that their 401ks went down 25%, and your portfolio is probably up 25%. As long as you were on the right side of the trend, you had a really good year. That's my opinion.
And it was a great year. Again, we'll talk about this at the first of the year when we wrap up the year, but let's talk about last week specifically, because holy cow, I mean, it was a great trading year. And this is where, as a trader, I love down years. I love down markets. I love down years. They come every 5 or 6 years. That's all you get for them. But they're really fun and they're really dynamic if you're in the right spot. But this last week, this was kind of like the cherry on top. We had so much news this week. Now, we're just looking at the U.S. markets, but there were 4 central banks that announced rate hikes this week, and there was just crazy movement. The currency markets, the rate market, the crypto market, the stock market, there was just crazy moves this week, and this year has been way more volatile than pretty much all the past years, except for that little bit of volatility we had from COVID. Let's talk about what happened this week. The markets were down again, but I want to point out we had a 6.2% weekly range. That is greater than 2 standard deviations at the moment. That's just a big, big move. And at one point, we were up 3 or 4% for the week, and we ended up down 2% for the week. But let's talk about what happened this week. So we've been talking about the CPI. And if you remember last week, I said, look, right now the market we called it 60-40. 40% will break up to the upside, 60% will break down to the downside. I said, we don't know what's going to happen, but we'll know by the end of the week. So what happened is we got the CPI, and it came out cool. And if we take a look, we can see that the CPI, the numbers were much lighter than expected. The overall number, 0.3, was a forecast, 0.1 was the actual. Core CPI came down, year-over-year CPI came down. The market gapped up 3%. The S&P, the NASDAQ was up over 4%. By the end of the day, it had lost it all. That was a really bad sign early on. Then we get the FOMC come out. After this great report, the market, again, it was excited at first. It sold off a bit. And then we had the Fed come out. They raised by 0.5 basis point as expected. But the problem was they were more hawkish than the market expected. And most of the members were showing higher interest rate targets by the end of 2023 than the market was projecting. And so we had, again, another sell-off on Wednesday. So we had the big gap up, sell-off on Tuesday, the sell-off on Wednesday. Now, I actually feel like that was okay. That was just regular movement within the range. I really felt that Thursday was the day. And this is funny because we had such big news with the CPI and the FOMC. I remember on Thursday when we got retail sales way worse than expected, down 0.6, expected negative 0.2. But take a look at these manufacturing numbers. Empire State down 11. Philly Fed down 13. These are lousy numbers. These are terrible numbers. So going into this week, the market had this expectation that, okay, inflation was cooling down, but economic activity was holding up. And the hope was that the Fed was going to back off, economic activity wasn't going to go negative, and everyone was going to have this soft landing. We got this back off on CPI. Everyone was like, okay, that's what we expected. Inflation's coming down. The Fed's going to back off. The Fed came out and said, guess what? We're not backing off. We're actually going to go harder than you thought. And then the very next morning, we get this information that the economy is way weaker than people expected. So this is like the worst case scenario. Yes, inflation is coming down, but it's coming down because of weak economic growth. And yet the Fed comes out and says, we're going to push on the brake harder than you thought. The market did not like that at all. Darren, what did you think about the news coming out this week?
It wasn't so much the news that, I mean, look, the Empire Manufacturing, Philly Fed Manufacturing, I mean, those are both, I mean, especially the Empire, manufacturing number just, blew away expectations. What caught me this week was some statements that Powell made. And I'm going to have to condense this down to get the gist of it. But he basically said, we don't know if a recession is coming. We don't know how long it's going to be. We don't know how deep it's going to be. And at the same time, he said something to the effect of, we're not sure what the persistence of inflation is going to be. And it was a very short speech, but I think it's statements like that throw the credibility of the Fed outside of the two standard deviation that you would expect. And most of the time, the Fed says something, and you have at least some faith that they know what's going on. I mean, you and I have been beating the Fed about the head and shoulders since 2020 that they've got to get ahead of interest rates, and they didn't. Now they're in this situation where they're behind the curve, and I think there's some people at the Fed that secretly say the Fed funds rate has to get up to 7%. It has to at least get up to inflation to get a hold of that. But if you're saying these are some of the smartest financial people in the U.S., and they're saying we don't know if there's going to be a recession and how bad it's going to be, that does not put a lot of faith in that the Fed knows what it's doing. And it really looks like it's the blind leading the blind right now. And I think a lot of not a lot of your lower tier fund managers, but I think a lot of the heads of the big banks are scratching their head at that situation and going, we now need to rework our entire investment portfolio. And we're talking, if there's a word for it, a multi-portfolio portfolio, to reflect the fact that we don't think the Fed knows what it's going to do. So this data is awful, but I think what is coming out of the talking heads at the Fed is throwing a lot of, what do you want to call it, a lot of confusion into the market.
No doubt. And one of the things that, again, the market was hoping, because the Fed has come out and says, hey, everything we do has a lag to it. So the market was hoping that, they're going to understand there's a lag. So when the economic news starts to weaken, they'll say, we understand there's a lag. We're going to back off. They did not do that. They hit the brake even harder this week. So look, all of this is what we call cocktail talk. It's all very fun to talk about and interesting. But I really just want to get into the price action, because whatever our opinion is, whatever we say, it doesn't matter, because the chart is the chart. Let's quickly go over performance. Dow down 2%, S&P down 2.5%, Q's down 2.75%. So everything down 2.5%. Oil had a little bit of a pop, but it actually sold back off on Thursday, Friday. It was a down week across the board. And this is what we've been talking about. Remember, we have been showing charts for the last 2 weeks about this trend line. Now, we don't have all the year here, but there has been this very clear trend line that happens to coincide with the 200-day moving average. And we talked about this being a major, major point on the markets. And this was the gap up after the CPI. And look at that candle. That is a nasty, nasty candle right at this really key point of resistance. But we talked about, hey, look, we're in a range. There's some really good support down here at 392, 393 on the spiders. And until it breaks below that, we don't know. And Darren, you brought the numbers up. You said 40% chance it breaks higher, 60% chance it breaks lower. And I said, we don't know, but we will know by the end of the week. Here we are at the end of the week. We know. Now, this is where I've been more bullish than Darren. Darren's been more bearish. I've been more bullish during this move higher. And at this point, I have to, whether I want to or not. I don't care how I feel. I don't care what my overall analysis is. The chart is the chart. And as traders, we trade charts, not our opinion, not the market we want it to be or think it could be. We trade the market in front of us. So I, on Thursday, had to change my mind to where I'm now more bearish than bullish. Darren, what do you think about that?
Yeah, I mean, it's one of the things you and I were talking about, and I think you made the comment is you can't fight the charts, you can't fight the technicals. And I said, well, you can, you just won't make money at it. One thing that you almost have to take a look at this from a psychological point. I mean, this is one thing that we go over is trading psychology. If you could back out to the chart of the S&P, the Qs, and the VIX, there's an interesting thing that happened this week that I want people to take a look at. Okay, you really see this. And so you take a look at the VIX, and this is the same time frame as, for the S&P, right here. We're just looking at the last week. Now, you can see Tuesday, Wednesday, Thursday, and Friday were all crappy days. But you look at the chart of the VIX, the only day you look at Tuesday, Wednesday, Thursday, you had bad price action, but a declining VIX. It was only on Friday that the VIX finally popped. So there was a lot of hopium being smoked this week when you got that bad of a price action, but the VIX is still going down. I mean, so there was a lot of, this was, I think, the last gasp of any semblance of performance chasing. People thought, okay, we're at a bottom. Let me get in. We're at a bottom today. It's got to get better. We're at a bottom today. Let me put some more money in. And then finally, they got smacked in the head and said, oh, Friday, oh no, we're below the 50-period moving average. This is not a bottom. I need to start getting hedged. You don't see that kind of price action bifurcated with the VIX very often, but it's one thing that really caught my attention. Taking a look at it. I mean, and keep that in mind. Declining price action with a declining VIX just doesn't happen that often. And when it does, you can see there's a psychological disconnect between the money managers and the market itself. And when that happens, their minds get clouded the same way that our minds get clouded at times as well. And when that happens, I think that's an opportunity. And that's why I think we're going to go lower. This could be an ugly next 2 weeks till the end of the year. Just looking at comparing the VIX to the actual price action.
And Darren, I totally agree with you. This last 2 days, anyone who thought there was going to be the Santa Claus rally at the end of the year, they got punished. And there is nothing out there saying that we're going to have anything but pain over the next 2 weeks. Now, look, we don't know exactly what's going to happen. All we can do is look at charts. But the charts are saying it could get ugly over the next 2 weeks, 3 weeks, 4 weeks. We just don't know. It is a really bad charting pattern. Let's talk about this week. So we had this huge week with all this news. This week we have a week with no news. We're going into the holidays. Now, typically, these holiday weeks generally have a bullish bias. There's not a lot of the pros around. They've all closed up their books. And so all of the newbies, all the rookies are out there and they only know how to buy stuff. They typically have a bullish bias. This time, I don't think we have those newbies, those rookies out there throwing money at markets. I think we're going to have more selling. We do have to recognize that we just had what's called quadruple witching, which is where we've got futures, options futures, commodity futures all expiring on the same day. That can actually cause markets to have some short-term price movements that aren't the true trend. I really want to see the first part of next week to see how much of this selling was due to the quad witching. I still think we're going down, but I think we could get a tiny bit of relief maybe Monday, Tuesday, but I still think you want to be short. The markets, the charts are all telling you to be short. We are now moving into holiday trading. Everything is winding down for the year. All the pros are winding down. There's going to be some lower volume. That doesn't always mean lower volatility. Sometimes it does, sometimes it doesn't. But I think we're going to get some more selling. Again, the person who typically is out there buying these last 2 weeks is the newbie, the rookie, the person that trades, on the side. They're gone. They're gone at the moment. I don't think there's going to be that holiday rally that everyone was hoping for. Now, this is going to be a full trading week. There are no market closures. However, the market is closed next Monday. As I said earlier, this is the last trading room for the rest of the year. Markets will be closed on Monday and then the Monday after New Year's. We expect these 2 weeks for the market to drift a little bit lower. And then we think when the markets come back in January, probably we're going to see a new low. And this is kind of what I wanted to talk about in this session, because I wanted to show you a chart of the S&P for the entire year. And you can see that it topped out in the middle of March. And we had a decline that lasted about 3.5 months. And we bottomed out in June. And then we had this massive rally back up to the 200 period moving average. We topped out in the middle of August, and we fell all through until the middle of October. That was 2 months. So we had one big fall, 3.5 months, 2 months. If you take a look, we topped out on December 1st. If we take a look at, okay, we think it's going to be 2.5, 3 months until we reach a new low, because that's what the chart pattern says, we're possibly looking at a new low in the end of January, early February. January does not look like it's going to be a good month this year, at least how the charts look right now. This last week here, we just don't have much as far as economic activity goes. I don't think you really need to pay attention to any of the news. All the news that people cared about, it happened last week. To update our weekly outlook and our monthly outlook, we were at a +2 about 3 weeks ago. We backed down to a +1. We then backed down to a 0. And you can see for the first time since really October, we're now back to a -1. And all we're waiting for is a clear break of the 50-day moving average, which we pretty much got. We want 1 or 2 more candles. I could see easily early next week, we go to -2 on a monthly outlook. All of a sudden, you can see we are definitely back to a more bearish tone like we've been for most of the year, except for the months that we've had some bounces. The technicals are screaming at you to be short, not long. Let's take a look at some sectors.
You can see, let's take a look at that histogram right there. I mean, energy had a positive week there, and it kind of needed it, but we're going to see that really didn't move the needle a whole lot. Everything else was not looking pretty good. Utilities held it out there the best, only down 0.5% right there. Your 2 weakest ones, consumer and communication services. And, I think that it's consumer. The numbers on consumer are driving us. When you're taking a look at how people are, what their spending habits are, it's been a balance. We've been talking about this before. It's been a balance between rising energy prices, rising rents, and buying, staples and discretionary items as well. So if the consumer is weak, I mean, that's a major part of the economy right there. If the consumer is weak, I think people are looking forward and saying there are some dark clouds on the horizon. And you got to remember, consumers been weak for quite a while. I mean, we've had -2s and 0s, -1s for a long time. I'm going back and looking at my notes right there, and we have to go back a couple of months, several months, almost probably 4 months before we had anything that was positive as far as consumer goes. Everything else was down about 2%, 2.5%. So let's take a look at the individual sectors right here. You can see, I mean, we just pulled back, a nice orderly pullback in utilities, right back to the 20-period moving average. If you took a look, I mean, that's 4 really ugly candles right there, but you didn't have any massive gaps to get down. I mean, you have one between Thursday and Friday. It wasn't that bad, but you can see it looks like we got that long lower shadow on Friday. It looks like some buyers did come in right at the 20-period moving average. So I'm mildly bullish on utilities, at a +1 right there. Now you look at communication services, And last week we were to zero. I'm in a -1 right here. We just broke below the 50 right there. We didn't make a new, it had a pretty good thing. We're at support though right there. You can see right there. We didn't make a new swing low on Friday. We just kind of held in there. But you've got several periods of support below this. I think this is one that either stagnates sideways right at the support level right there, at the 48 level, or it just bleeds down into the following support. But I don't think we see any massive violent moves. This is just going to be more apathetic moves sideways to down. Real estate's one. We were mildly bullish on it before. We're to zero right now. I mean, we're pegged pretty good between the 20 and the 50 period moving average right there. It depends on how you draw the support line. I mean, you can make a case that we're right at support that we have been for the last month right there, and we just hang out. Are we range bound for a little bit? Yeah, we quite very well could be range bound here, but this is one that I think you could find a mix of bulls and bears in real estate, or conversely, you could just stay out of it and wait for it to reassert a direction. We're going to be seeing a lot of things that are rated at zero right now just because of the market action that we saw this week. Looking at industrials, same case right there. I mean, industrials have been looking really good for a long time, but they just kind of fell apart. I mean, this week was pretty telling. I mean, it had a better candle on Friday than a lot of other things did, but I mean, you can see you go from we were at a +2 on industrials all the way down to a 0 in the course of 4 days. I mean, that's a heck of a move right there. I mean, you went from probably 103 down to 98 there, so that's a 5% move, 5% range right there in industrials. From something that was looking pretty good is now I think we're going to be in wait and see mode on that one. Looking at healthcare, got a very similar situation. Last week healthcare was at a +3. And, we've had that, again, that huge range where it just comes down, down, down. And this did have some nice gaps in it right there. So this is one thing. You take a look at that lower shadow on Friday, make me the case that, hey, maybe we did hit a bottom right there. We're going to wait and see. But I mean, to go from a +3 to a 0 in the course of 5 days, really, I mean, that's a pretty major move right there. It shows how much weakness is out there. Looking at financials, we were to 0 last week. We're to -1 right now. I mean, I would say firmly below that 50 period moving average. That confirmation on Friday. I mean, we were just touching it on Thursday, and this is one of those ones where very interest rate sensitive sector right here. And if it looks like the bank's going to be having difficult times making money, it looks like the major wirehouses are going to be having trouble. If there's decreased trading activity. If you're not getting new assets under management, then if the economic outlook is not looking good, financial sector just does not look very good. So mildly bearish, -1 on financials right now. You can see consumer. We were at -1 last week. We're at a -2. You can still say, you can make me the case we're range bound, but your last support right there, that's in October. That's a long time ago. And you're sitting right at it. One sneeze the wrong way, and this thing goes below it. If you take a look at the volume on Tuesday through Friday, right there, we've got rising volume. Not massively rising volume, but you can see it did accelerate to the downside, and volume accelerated to the upside as well. So this looks like to be one of those ones where we had the initial people want to get off the ship. Now more and more people are getting off the ship. They're having trouble finding some lifeboats. So we're going to take a look at the volume next week. We're going to take a look at the price action next week as well. But definitely one of the weaker sectors right here, consumer. Tech, I mean, despite all the, we were at 0 last week. I mean, despite all the market moves right here, we're at 0. I mean, it's a less of a 0 than it is a very, very weak +1. But we're just we're between those moving averages right there, and I think that as we said before, tech is going to lag. I think this is one of the ones. The best you can hope for is that we stay in this range for the next month, and hopefully let the 50 period moving average catch up. And as it catches up, sometimes that will that will bump the price action to the upside. But right now, we're to zero, and I think range bound is about the best you're going to get out of tech. Looking at materials, it fell right back into the middle between the 20 and the 50, so we're to zero on this one as well. Um, you go back there, and we're at the bottom of a range. Got a little bit of a gap to fill in. Do we fill it? Quite possibly. I think this holds for a little bit right now, because there is still some demand for the materials out there, and we're going to wait and see what we're going to start to see where industrials are really going to be coupled to materials. Because if industrial demand for basic materials decreases, the two are going to go hand in hand right there. But we'll just keep a look at the technicals and see which way they go. Energy was a -1 last week, and we're still at a -1 this week. I mean, it held up pretty decently, but we're still below that 50-period moving average right there. So we'll just wait and see where it goes. It was up remember that was the only sector that was positive for the week. So let's take a look, see where it ends up. This is another one. If we get demand destruction in the energy sector, then this could fall apart fairly quickly. Right now, it's holding in there, just mildly bearish on the energy sector. So as you can see, on the weak side, consumer to -2, financials, communication services, and energy all to -1. We've got 5 sectors at zero: material, healthcare, industrials, technology, and real estate. So half of the sectors that make up the S&P 500 are to zero. We don't know if they're bullish. We don't know if they're bearish, and we want to stay away from them. The only thing that's looking positive right now is utilities. So let's take a look at some potential trades right here. Now, last week we were long SPG, and this one held up really, really nicely. I mean, despite all the market action, we're still in this base between 115 and 120. It's pretty good right there. It was only down 0.37%. So there's a little bit more time left on this trade. I'm happy. This is one of the ones you're down so little. It makes sense to give it a little bit more time to run. I'm not worried about this trade at all. This week, we're looking at Host Hotels. Symbol for that is HST. We're going to be looking at it sideways. And pull into the chart right now. We're at the 17 level right now. Okay, so how do we want to play this right now? We think it's just going to hold out right here in this level. So the way we're going to play this is 15, 17, 19 on a butterfly spread. Doesn't matter if it's puts, doesn't matter if it's calls. The risk graph looks the same as well. Sometimes sometimes you might get a little bit better pricing in a rising environment if you short those puts. If the volatility does begin to go up, there's usually a volatility premium on the puts. So if you wanted to take a look at a put butterfly, if you can get a better, it might be only a difference of 5 or 10 cents. But hey, look, take which edge you can. I'll definitely take a look at that. But we just think it's going to stay here in this range between probably 18, between 1550 and 1850, midpoint at 17. If it can stay in that range here, then I think it makes money. This one looks like it just wants to hang out right there. And communication services, last week we were long Comcast, and this one, it was a little bit weak. This one again has, Tuesday, Tuesday looked great, Monday looked great, but Wednesday, Thursday, Friday, it just did kind of, I don't want to say fall apart. For the week, it was down 2.35%. So this is one that if you have something that's not a vertical spread, if you have something that's like a diagonal spread, and you're right now in unhedged long calls, this is going to be one of those ones where you have to decide, did I size this for max loss to begin with, or do I need to just cut my position, move on to something else, and preserve my capital? And that's an important lesson to learn. Always know that before you go into the trade. This is one of the ones where it could bounce, but looks to be market dependent. Whichever way the market goes, I think is where Comcast goes. This week we're looking at Zoom. So that is ZM. Nice low base right there. You can see a very choppy price action as well. It just goes all over the place. So what's the best way to play this? You want to play it a little more conservatively. That December 30th, 67.71 bear call spread. You want to give it a little bit more time. Look, I'm fully out there for a January, December 23rd diagonal put spread out there. So go along those January 75s and short this next week 70 against it. I think is where you go. If it just hangs out there at that 70 area, which looks to be some pretty decent support for the next week, you're looking pretty good. And you just take it and decide if you want to hold it over Christmas or get rid of it. It's up to you. This one's looking pretty good for. It looks like it wants to break down. And healthcare. Last week we were long Amgen, and a lot of our longs did not work out well, and that's fine. We've made a lot of money on the short side, but this just totally broke down. I mean, this was basing nicely right around the 20-period moving average, and this broke through in a week below the 50 period. So this is no longer what we would consider to be a viable long position for us. Depending on what you've got, if you size for max loss, don't touch it. If it's one of those ones where you have something deep in the money, you've got some delta exposure, might be time to cut your losses and just move on. Now this week we're looking at Eli Lilly. This is a bull pullback, but you want to wait for confirmation. And you can see we came down, touched that 50-period moving average, nice lower shadow on Friday's action. But what I want to see on Monday or Tuesday is a higher high and a higher low. Get that confirmation right there. I mean, tattoo this on your mouse hand. Wait for confirmation to do it. So a couple of different ways you do that. Again, this is a type of period where we saw this early on, where either your trades need to be very, very short term, and you're taking a look at just capturing, $1, $2, or your trades need to be long term so they can sit through some, volatility, or for lack of a better word, they can sit through some market stupidity right there. So I'd be looking at that, going along the January's 350s, and then short this next Friday. I'd be looking at going long those January 350s, and then short this next Friday's, the December 23rd's 360s against it. And then again, make your decision. If it just holds out here for a little bit, I mean, you can even look at the 365s if you want it. If you get your confirmation in a couple of point range on Monday or Tuesday, then long those 350s, short the Friday's 365s. That's an equally viable trade as well. You just want it to not take off, and just make that confirmation for us and decide what you want to do. This is still looking pretty strong, compared to a lot of other things.
This week in industrials, we're going to take a look at something, but let's take a look at our trade last week. We had a trade on Plug Power, PLUG. Now, it was a 15-13 diagonal put spread. So 13 would have been the max gain point, and you can see it had a nice little bounce early in the week. But by the end of the week, it had faded. This trade looks really good. We had a little short-term bounce. Yeah, it went up about 4% last week, but this thing looks like it wants to break to lower lows. Being short in these kind of little pops, really good. So if we take a look at this week, FedEx is sideways. Now, the industrial sector, to me, it's a mix. The falling dollar is going to help industrials. The weakened economy is going to hurt industrials. This here is a stock that you can see had a big earnings miss. It got punished, and then it's crawled back up into some key levels here. However, it's not really going anywhere. So we really like to do sideways trades on stocks that have had some bad earnings and then just get put in the penalty box. So the big question is, where is this going to be based on your time frame? I am generally a little bit bearish to this market. So the stock's at 172 basically at this point, and I'm looking at 180, 160. Do we plunge below this 160? Probably not. Do we break out above this 180? Probably not. So that makes a really good little butterfly. 160, 170, 180. I'm only going to be doing it for a week. I'm not willing to stick my neck out too far on this one. You could go out to the December 30th if you want a little bit more premium, but I'm going to be keeping this fairly short term on FedEx. Financial sector was a weak sector. Last week we had PayPal short. PayPal went down over 5%, almost 6% down for the week. Great little trade here. You can see we're now reaching into this major support here. If you've got more time, I think you wait on this. I think this thing could go substantially lower. If you're fairly short on time on your trade, I think taking some profits and looking elsewhere makes some sense. This week, we're going to stay on the short side in financials. This is Digital World Acquisition Corp. This is a SPAC, and you can see here, we've just broken below this key level of 20. Now, I want to talk about this stock. This stock is a highly, highly volatile stock. You can see on November 1st, it was at $16. 2 days later, it was at $30. You do not want to play this stock as a short stock or a long stock. It's too dangerous. This is only options. Only options make any sense at all to trade this. So I really want to take a look at the 18s. As we just broke below this, I don't think we break below this support here for a little bit. So I'm looking at 18. I'm going to do an 18-20 bear call spread. I'm going to get about $1.10 on this, have 90 cents of risk, and looking really, really good.
All right, last week in consumer, we had a sideways trade in Kellogg's right here. And it was a butterfly with a 72 midpoint right there. It closed at 71.29. You really can't ask for anything closer on that one. So that was a really good trade. Really happy with that trade. It's one of those ones in a volatile week. You get something that doesn't move a whole lot. Usually needs consumer staple right here. Did very well. Can't complain. This week we're looking at GameStop at a low base. Okay, you've seen our video on GameStop on Eat the Rich. This is an actual bona fide trade though. This broke long-term support several weeks ago right here, and it looks to be accelerating to the downside. This is a genuine short move. This doesn't look like anyone's manipulating it right here. I mean, 24 for the longest time was support. Now we've lost $4. Lost 1/6 of its value in the past couple of weeks. We're down there at 20. So this one genuinely looks like it wants to keep going lower. So how do we want to do this? You want to play it short term and do a chicken bear. You just do this Friday's 2021 bear call spread. You want to go out to January 6th and give yourself a little bit more profit potential. I think that 18.22 is the way to do it. So you've got two different ways to play it. I would probably play this out to January, play that 18 to 22, and I think that's going to be it's going to give you more profit. So this one definitely looks like it wants to keep going lower right here. And technology, last week we were short Coinbase, and we're happy to say that Coinbase decided to give us 9% to the downside right here. So pretty happy about that. This looks like to be a pretty good trade. And some of these you just take like a gift. What we're looking at right now is Asana, ASAN. This is a nice bear rally. It confirmed on, looks like Wednesday it confirmed, but this still looks pretty good. And I'm going to say, like I said, that one of the trades we did last week, January puts are the thing to do. Go out to January. The VIX is still low. You're not going to be overpaying for these puts. And you go out there to get those 17 puts. And if volatility starts to increase and this keeps going lower, you're going to make money on two sides. You're going to make money on the delta, and you're also going to make money on the volatility as the volatility increases. I think 12 is a pretty decent profit target, going out to January right there.
Let's finish up with materials and energy. Last week we had a long in DuPont. And again, we're doing a lot of diagonal spreads here. Basically saying, hey, if it holds in this range, we're very, very happy with it. As you can see, we didn't have a great week, down 1.4% for the week, and we are right at support levels. So I think this one needs to be dealt with on Monday. If it breaks below the support point on Monday, I think it's time to cut and run. If we can hold this level and move a little bit up, the trade looks just fine. The trade looks absolutely fine on DuPont. This week, we're going to go with a sideways trade on Cleveland Cliffs. CLF is a ticker symbol. This is a steel company. And we're basically looking at a butterfly. Now, with butterflies, you have to call two things on a butterfly. You have to call where it closes and the day it closes on. This is where, again, time frame matters, and then your targets matter. So if you could see here, I've gone out 2 weeks, December 30th. You could do a December 23rd. You could do a January 6th. You could choose a different time frame, but basically when you have a butterfly, you have to choose the time frame. Again, you're looking at, you don't really care where it goes Monday, Tuesday of next week. You care about where it is December 30th. So if you are slightly bullish, you want to do a little bit higher butterfly, slightly bearish, you want to do a little bit lower butterfly. If you're truly neutral, you're going to do it in the middle. Now, I am slightly bearish. The stock right now is closing at 15. You can see there's a really good bit of resistance in the high 16s. And there's a little band of support down here at 14 and a heavy band of support down here at 13. I'm looking to play this a little bit bearish. So I'm going to be looking at the 12, 14, 16. As you can see here, basically I'm saying 14. This is where I think this stock is likely to be on December 30th. And if it goes above 16, I don't lose any more money after that. If it goes below 12, I don't lose any more money below that. And I'm going to be playing this range in here. So you can see this is a butterfly, but it's slightly bearish. I need it to drift a little bit lower during my time frame. Energy last week, we had a short. I actually like energy as a short. I like it actually quite a bit. And not to give anything away, because we're going to be doing our year-end review in the 1st of January, where we basically wrap up 2022 and we give our projections for 2023. A little spoiler here. I think energy is going to be the worst sector next year. I know that's getting way ahead of ourselves. I'm only looking for like a couple weeks on energy. Energy is no longer looking bullish. Last week we took a short on PBR and it did fantastic, down 12.5%. Here's what you have to take a look at. Oil is back to where it was in December of 2021. Where are these stocks compared to where they were in December 2021? And you're going to see that they are significantly higher than they were. The trade I want to take out for this week is Cheniere Energy, LNG. Now, this is natural gas. This is the U.S.'s largest natural gas provider. Now, the stock is trading right around 157. Last year, in November, natural gas is the same price as it was today. However, last October, the price of this stock was $90. So here we have natural gas, same price as where we were about a year ago, and the stock was at $80. Today, it's at $157. I think we've got some air in this. Look, I'm giving this huge, big macro picture. I don't really care about that. I'm looking at 1 week. I know it's kind of funny to give this big, long macro picture and then say, all I really care about is the next 5 days. I'm going to do a little chicken trade here, 155, 160 bear call spread. But this is going to be probably my top trade, not this stock specifically, but the energy sector. If we don't significantly increase prices, these stocks are all wildly overvalued compared to where they were last year when oil and gas prices were much lower. So I'm looking at just a 1 week, 155, 160 bear call spread. But going into next year, I think this sector has the potential to be maybe the worst sector of the year, when this year it was the best sector. It was great. We rung the register a ton of times on energy long. We might just have to flip and go energy short this next year. If you have any other trades you want to share with the rest of the group, log on to maverickTrading.com. Share it with the rest of the group. We always like to see our traders working together to help the group make a lot of money. Let's wrap up this last trading room of the year. I don't care what your opinion is. I know that sounds rude, but the charts are what we trade. We trade price action at Maverick. We can talk about what's happening and have some fun discussions, but when it comes right down to it, if something's in a downtrend, we're short. If something's in an uptrend, we're long. The market has confirmed. It's confirmed. I don't care what you feel. I don't care what you believe. It doesn't matter. We trade the charts, and the charts are telling you to be more short than long. We expect tech to continue to underperform. We've talked about this for a while. It's been underperforming. This week is the next 2 weeks are going to be lower volume, but could be higher volatility because of it. We don't really know. Sometimes you get lower volume and lower volatility. Sometimes you get lower volume, and because of the low volume, there's not as many market participants, you get higher volatility. There is a potential for a nasty next 2 weeks. I don't know if that's going to happen, but I think you have to realize there is the potential that there are a lot more sellers and buyers on a thin week that could cause exacerbated price movements. We'll just have to wait and see. We are definitely not going into 2023 as big bulls. The market is just not telling you to be there. We hope everyone has a wonderful holiday season. Merry Christmas to everybody. Happy Hanukkah, whatever holiday you celebrate. I hope you have a good one. Everyone have a great rest of the year. Goodbye, everyone.
Good trading, everyone.